What if I told you that the decision you make about your mortgage this year could either cost you over $226,000 or save you every single dollar of it? That's not clickbait, that's real math. And I'm going to prove it to you in the next few minutes. Right now, mortgage rates are shifting. Fixed rates are edging lower, adjustable rates are getting volatile, and most people have absolutely no idea what any of it means for their wallet, their wealth, or their future. But you are not most people. You're here on Infinite Capital Mind, and that means you're the type of person who wants to understand money at a deeper level. So today, we are breaking down everything happening with mortgage and refinance rates right now, what the numbers mean, what the banks don't tell you, and exactly what moves you should be considering. Stay locked in. This one could literally change your financial life. Welcome back to Infinite Capital Mind, the channel where we turn financial complexity into wealth-building clarity. If you're new here, welcome to the family. This channel is built for people who are serious about building wealth, mastering personal finance, and creating a life of financial freedom.
Don't miss out.
So if that's you, make sure you hit that subscribe button and tap the notification bell so you never miss a video. Now, whether you're a homeowner thinking about refinancing, a first-time buyer trying to figure out what you can afford, or simply someone who wants to understand how interest rates impact the economy and your money, this video is built for you. Here's what we're covering today. Number 1, the exact mortgage and refinance rates right now and what they actually mean. Number 2, the 30-year versus the 15-year mortgage breakdown and the $226,000 difference I mentioned in the hook. Number 3, fixed rate versus adjustable rate mortgages. Which one wins in today's market? Number 4, refinancing in 2026. Is it the right move for you right now? Number 5, the most powerful strategies to lock in the lowest possible rate. Let's get into it. Section 1, today's rates. The real numbers. Okay, let's talk about what's actually happening right now in the mortgage market as of the end of May 2026. According to data from the Zillow lender marketplace, here are today's national average mortgage rates. 30-year fixed mortgage, 6.33%, down 3 basis points. 20-year fixed, 6.26%. 15-year fixed, 5.79%. 5/1 ARM, 6.45%, and this one jumped up 24 basis points just recently. 7/1 ARM, 6.17%. 30-year YA loan, 5.80%. 15-year VA loan, 5.43%. And for those of you looking to refinance, here are today's refinance rates. 30-year fixed refi, 6.28%. 20-year fixed refi, 6.30%. 15-year fixed refi, 5.80%. 5/1 ARM refi, 6.21%. 7/1 ARM refi, 6.23%. 30-year VIA refi, 5.76%. 15-year VIA refi, 5.41%. Now, these are national averages. Your specific rate could be higher or lower depending on where you live, your credit score, your down payment, and your lender. Expensive areas like New York or San Francisco tend to have higher averages, and we'll talk about exactly how to beat those averages shortly. But here's what I want you to notice first, something subtle that most people completely miss. The 30-year fixed just dropped 3 basis points. Now, 3 basis points doesn't sound like much, but in the mortgage world, small moves have massive consequences. A single percentage point difference on a $300,000 loan is over $60,000 across 30 years. So when rates move, even slightly, smart people pay attention, and right now, rates are moving. Section 2, the $226,000 decision, 30-year versus 15-year. All right, let me deliver on that promise I made in the hook. Let me show you the $226,000 decision. Let's say you're buying a home and you're taking out a $300,000 mortgage. You have 2 main options most people consider. Option A, the 30-year fixed mortgage. At today's rate environment, let's call it 6.41%. Your monthly payment toward principal and interest would be roughly $1,878 per month. Now that sounds manageable, right? That's why the 30-year is the most popular mortgage in America. You spread those payments over 360 months, so the monthly number feels affordable. But here's what the bank is quietly celebrating every time you sign that 30-year contract. Over the life of that loan, you will pay approximately $376,254 in interest, $376,000, on top of your original $300,000. So your $300,000 home, you're actually paying the bank over $676,000 for it. Now let me show you option B, the 15-year fixed mortgage at a rate of around 5.80%. Your monthly payment jumps to approximately $2,499 per month. Yes, that's about $621 more per month than the 30-year. But watch what happens to the total interest you pay. With the 15-year, you pay approximately $149,869 in interest over the life of the loan. Do that math with me for a second. $376,254 minus $149,869 equals $226,385 saved. $226,000 just by choosing the 15-year over the 30-year. Now, I know what some of you are thinking, but the monthly payment is $621 higher. I can't afford that. And that's a completely valid point. Personal finance is personal. Not everyone is in a position to take on that higher payment. The 30-year is not evil. For many people, it's the right choice because it gives you flexibility and cash flow. But here's the wealth-building mindset I want you to adopt. What if you took that $621 per month that you'd be paying extra on a 15-year and instead invested it into the market at an average return of 8% per year over 15 years? You'd have roughly $215,000 in additional wealth. So the 30-year can work for wealth building too, if you're disciplined enough to invest the difference. The question is, are you? That's the kind of thinking we cultivate on this channel. Not just, what's my payment, but what is my total cost of wealth? Section 3. Fixed rate versus adjustable rate. Which wins? Analytical and calm, like a trusted financial advisor. Now let's talk about one of the most misunderstood debates in real estate finance. Fixed rate versus adjustable rate mortgages. And I say misunderstood because most people default to fixed rates without truly understanding what an ARM offers. And right now, the market is doing something really interesting. Let me break it down. Fixed rate mortgage. Your interest rate is locked in for the entire life of your loan. It doesn't matter if rates go up to 8% next year or drop to 4%. Your rate stays exactly the same. Predictability, stability, peace of mind. Today's 30-year fixed is at 6.33%. The 15-year fixed sits at 5.79%. You lock that in, you're set for the life of the loan. Adjustable rate mortgage, ARM. An ARM gives you a fixed rate for a set number of years. Then it adjusts periodically based on market conditions. So, with a 7/1 ARM, your rate is locked for the first 7 years. Then it adjusts annually for the remaining 23 years. ARMs typically start lower than fixed rates. That's their appeal. A lower rate up front means lower payments in those early years. But here's what's happening right now that makes this more complicated. Look at the 5/1 ARM today. It's sitting at 6.45%.
Things are tricky.
That's actually higher than the 30-year fixed at 6.33%. And the article data shows the 5/1 ARM jumped 24 basis points in a single day. That's what volatility looks like. So right now, in this particular market environment, adjustable rates are not necessarily giving you a better deal up front compared to fixed rates. That's unusual. That's significant. What does this tell us? It tells us that the market is uncertain. Rate volatility on ARMs signals that lenders are pricing in risk, and that risk trickles down to you as the borrower. My take for the infinite capital mind community. If you're buying a long-term home, your forever home, or a place you plan to stay 7+ years, the fixed rate is likely your best friend right now. You get stability, and the ARM isn't even offering a better deal today. If you're buying something you plan to flip, sell in under 5 years, or it's a strategic real estate investment, then an ARM could potentially make sense, but only after a very careful analysis of your specific situation. Talk to your lender.
Do the math.
Run the numbers both ways. Don't just go with what feels comfortable. Go with what the math tells you. Section 4. Should you refinance in 2026? Now, let's talk about refinancing, because this is where things get really exciting for a lot of homeowners right now. Here's a stat that should make your ears perk up. Refinance applications have surged over 62% year over year. 62%. Why? Because mortgage rates have come down more than a half point compared to where they were last May. And when rates fall, even half a point, millions of homeowners suddenly have an opportunity to save money every single month. But before you rush to call your lender, let me give you the framework to decide if refinancing makes sense for you specifically. The 5 questions you must answer. Before refinancing, question 1. What's your current rate? If you bought your home in 2022 or 2023 when rates were much higher, potentially 7%, 7.5%, or even 8%, refinancing to today's rates in the low 6s could mean hundreds of dollars saved every single month. That's real money back in your pocket. If you already have a rate below 6%, refinancing probably doesn't make financial sense right now. Don't fix what isn't broken. Question 2. How long do you plan to stay in the home? Refinancing costs money upfront. Closing costs typically run between 2% to 5% of the loan amount. So if you're refinancing a $300,000 loan, you might pay $6,000 to $15,000 in closing costs. You need to calculate your break-even point, the number of months it takes for your monthly savings to recoup those closing costs. If you save $300 a month on your payment and you paid $9,000 in closing costs, your break-even is 30 months. If you plan to stay longer than that, refinancing wins. If you're moving before then, it's probably not worth it. Question 3. What's your credit score right now? This is huge. The best refinance rates go to borrowers with credit scores of 740 and above. If your score has improved since you first got your mortgage, you might qualify for a significantly better rate than you had before, even if market rates haven't moved much. Question 4. What's your home equity? Generally, you want at least 20% equity in your home before refinancing to avoid paying private mortgage insurance, PMI. The more equity you have, the better rates and terms you can access. Question 5. What are your goals? Are you refinancing to lower your monthly payment, or to pay off the loan faster, or to tap into home equity for investing? Each goal leads to a different refinancing strategy. Now here's what the forecasters are saying about where rates are headed. The Mortgage Bankers Association expects the 30-year rate to land between 6.4% and 6.5% through the rest of 2026. Fannie Mae is slightly more optimistic, projecting a rate of about 6.3% through year-end. What does that mean for you? It means we're likely not going to see dramatic rate drops in the near future. If you're waiting for rates to fall to 5% before refinancing, you could be waiting a very long time. And every month you wait at a higher rate is money you're not getting back. The people who win in real estate and personal finance are the ones who make smart decisions based on today's data, not the ones paralyzed waiting for perfect conditions. Perfect conditions may never come. Opportunities only reward the prepared. Section 5. How to get the lowest possible mortgage rate. Alright, let's talk about what you can control, because this is where wealth building really starts. You can't control the Fed, you can't control the economy, but you can control the rate you personally qualify for. Here are the most powerful strategies to get the lowest mortgage rate available to you. Strategy 1. Dominate your credit score. Lenders give the best rates to borrowers with credit scores of 740 or higher. The difference between a 680 score and a 760 score can be as much as a full percentage point on your mortgage rate. On a $300,000 loan, that's potentially $60,000 in additional interest over 30 years, just because of your credit score. How do you improve it? Pay every bill on time, every single month. Keep your credit card utilization below 30% of your available limit. Don't open new lines of credit right before applying for a mortgage, and dispute any errors on your credit report. They're more common than you think. Strategy 2. Save a bigger down payment. The more you put down, the less risk the lender takes on, and they reward you with a lower rate. A 20% down payment is the traditional benchmark. It also eliminates the cost of PMI, which can add hundreds of dollars a month to your payment. If you can push your down payment to 25% or higher, many lenders will offer you even better rates. Strategy 3. Lower your debt-to-income ratio. Your debt-to-income ratio, or DTI, is the percentage of your gross monthly income that goes toward debt payments. Lenders want to see this below 43%, and the best rates typically go to borrowers below 36%. If you have car payments, credit card debt, student loans, pay them down before applying for a mortgage. Not only will it improve your DTI, it'll likely boost your credit score too. Strategy 4. Shop multiple lenders. This one is criminally underused. Most people apply to 1 or 2 lenders and accept whatever rate they're offered. But research consistently shows that borrowers who shop at least 3 to 4 lenders save significantly more over the life of their loan. Apply for pre-approval with at least 3 lenders and do it within the same 45-day window. When you do this, the credit bureaus treat all those inquiries as a single pull, so it minimizes the impact on your credit score. When comparing offers, don't just look at the interest rate. Look at the APR, the annual percentage rate. The APR includes the interest rate plus fees, discount points, and other costs. The APR is the true cost of your loan, and it's the number that gives you an apples-to-apples comparison between lenders. Strategy 5. Consider buying down the rate. This is called paying discount points. 1 discount point equals 1% of the loan amount, and it typically reduces your rate by about 0.25%. So on a $300,000 loan, 1 point costs $3,000 upfront, but lowers your rate. If you plan to stay in the home long term and you have the cash upfront, buying down your rate can make a lot of financial sense. Do the break-even math. How many months will it take for the monthly savings to recoup the upfront cost of the points? Strategy 6. Time your application. Strategically, mortgage rates move daily, sometimes multiple times a day. If rates have been trending down and you're ready to lock, consider locking your rate sooner rather than later. If rates are rising, some lenders offer float-down options that allow you to benefit if rates drop before closing. Talk to your lender about rate lock options. Don't leave that conversation to chance. Section 6. The wealth-building mindset around real estate. I want to take a step back from the numbers for a moment and talk to you on a deeper level, because this channel isn't just about rates and percentages. It's about building a mindset that creates lasting wealth. And here's what I see far too often. People treating their mortgage like a burden instead of a tool. Your mortgage is one of the most powerful wealth-building vehicles available to the average person. Why? Because real estate is one of the few assets where you can control a $400,000 or $500,000 asset with a fraction of that amount down, and your tenant or your future self who builds equity is effectively paying it down over time. But here's where the wealthy think differently. They don't just ask, can I afford this payment? They ask, how does this asset fit into my overall wealth strategy? They run the numbers. They compare the 15-year versus the 30-year. They consider whether to refinance or invest elsewhere. They shop multiple lenders. They protect their credit score like it's a financial superpower, because it is. The data tells us that refinance applications are up 62% this year. That means millions of homeowners are waking up to the opportunity in front of them. Are you one of them? Rates might not drop dramatically from here, but your actions, your credit score, your DTI, your down payment, your lender shopping, these are things you can control today. Wealth isn't built in the moments of perfect conditions. It's built in the moments where you take smart, strategic action with the information available to you right now. That's what Infinite Capital Mind is all about. Alright, let's bring it all together. Here's what you learned today. Current 30-year fixed rates sit at 6.33%, edging lower. The 15-year is at 5.79%. The 15-year mortgage can save you over $226,000 in interest compared to the 30-year on a $300,000 loan. But the 30-year gives you flexibility if you invest the difference. Adjustable rate mortgages are showing significant volatility right now, and some ARMs are actually more expensive than fixed rates. Proceed carefully. Refinance applications are surging 62% year over year. Ask yourself the 5 key questions before jumping in. The best rates go to people with excellent credit, strong down payments, and low debt-to-income ratios. These are all things you can work on starting today. Always shop at least 3 to 4 lenders and compare APRs, not just interest rates. Now here's your homework from Infinite Capital Mind. This week, pull your credit report. Know your score, know your DTI, and if you currently have a mortgage at 7% or higher, call your lender and start asking about your refinancing options. Don't wait. The opportunity is in front of you right now. If this video gave you value, smash that like button. It helps more people in this community find content that actually moves the needle on their financial lives. Subscribe if you haven't already. We drop finance, investing, and wealth building content every single week right here on Infinite Capital Mind. And drop a comment below. Are you currently a homeowner thinking about refinancing, or are you working toward your first home purchase? Let me know where you are on your journey. I read every single comment. I'll see you in the next one. Keep building, keep growing. The wealth you want is closer than you think.